Roth conversions may save substantial amounts of money in taxes. Here are 5 reasons, some of them are not so obvious, to consider a Roth conversion now. Hi, I'm Will Hoffman, founder and president of Hoffman Wealth Management, where we specialize in working with busy families and active retirees, helping them navigate the complicated scenarios of their wealth while creating the life that they desire. Nothing is certain except taxes and, of course, more taxes, particularly if you have large traditional retirement accounts. Many do not realize that stashing hard-earned money in traditional retirement accounts like IRAs and 401ks creates a ticking tax time bomb upon retirement. One way to prevent this is through harnessing the power of distribution planning, including using Roth conversions. Once you retire or start heading into lower income years, there's a great opportunity to do the advanced tax planning that will save money in the future. We call this time the income valley. Here are 5 reasons why we love Roth accounts, some obvious and some not so obvious. The first, Roth accounts can decrease your pre-tax balance and decreases future required minimum distribution bills. We should all be wary of required minimum distributions, or RMDs. RMDs grow based on the IRA account size, and they also increase as you age. So, at age 73, the RMD may only be about 4% of the account value, let's say $2 million, but that annual distribution grows to 6.25% of the account value at age 85, which could easily be $4 million, assuming a net growth of 5.5% per year. On a $4 million account, that RMD has grown from about $80,000 to $250,000. But that's not all. That RMD now needs to be added to Social Security for 2 people, and a couple has a taxable income of over $300,000 in many instances. In this case, additional retirement contributions to traditional retirement accounts hurt, not help. You essentially compound the tax problem with additional contributions to your traditional retirement accounts. To minimize taxes, it's essential to create a tax minimization plan as part of your accumulation plan. Just a little bit of a pro tip. It's important to note that although we want to build tax-free assets, we do not want to completely deplete tax-deferred and taxable accounts, as the diversification of the account types helps to maintain tax efficiency throughout retirement as the portfolio is drawn down. The second, Roth accounts are available through employer retirement plans, increasing the opportunity to invest. This means looking into Roth contributions, backdoor Roth conversions, and Roth conversions alongside a thorough review of after-tax account opportunities available through the employer, especially when tax rates are favorable. For example, some employers offer after-tax accounts that can be funded up to $69,000, plus catch-up contributions for a total of $76,500 in potential employer retirement plan contributions for 2024, much of which could be Roth or after-tax accounts. Roths come with no upfront deduction because you fund these accounts with money you've already paid taxes on. But once you turn 59 and a half, provided you've held the account for 5 years or more, you can withdraw all of your money, including investment gains, tax-free. And you're allowed to withdraw up to the amount you've contributed at any time without a penalty. Another pro tip for you, as a result of Secure Act 2.0, there are a couple of new provisions that could help you build your Roth accounts further. First, the annual catch-up contribution limit for IRAs, traditional and Roth, will increase to $10,000 starting in 2025 for those aged 60, 61, 62, and 62 in the same calendar year. In addition, your employer can now offer Roth matching contributions within your employer-sponsored retirement plan. So you could have the option to choose how you want your employer match allocated, pre-tax, which has been the traditional way, or Roth. The third reason we love Roth IRAs and Roth IRA conversions is Roth accounts increase other AGI-dependent deductions and decrease your Medicare IRMA surcharges. Having a Roth account will help keep income down, which decreases Medicare income-related monthly adjustment amount, or IRMA, surcharges, and increases other adjusted gross income dependent deductions, among other benefits. Income in retirement can significantly impact the IRMA surcharge because it is partially dependent on your modified adjusted gross income from 2 years prior. So, when you withdraw money from a tax-deferred retirement account, which is a traditional IRA or traditional 401k, the withdrawal counts as taxable income and increases your modified adjusted gross income. Conversely, withdrawals from a Roth account, which is a Roth IRA or Roth 401k, are tax-free and don't affect your modified adjusted gross income. By reducing your modified adjusted gross income through tax-free Roth withdrawals, you may also fall into a lower IRMA bracket and pay less for your Medicare premiums. Another major benefit of a Roth account are no required minimum distributions, which means your money can sit in the account and continue to grow tax-free, which makes early Roth conversions a good protection against higher tax rates in retirement. This also means that lower AGI could help you take larger deductions. For example, you can only deduct medical and dental expenses on your federal tax return if the expenses exceed 7.5% of your AGI. In addition, some states also have a separate medical expense deduction that is dependent on AGI. Therefore, a lower AGI can make it easier to qualify for a medical expense deduction. One more pro tip for you. Of course, a Roth account is favorable in retirement as all withdrawals will be tax-free. But it is also important to consider the other residual benefits that could come with building tax-free assets, such as decreasing your Medicare IRMA surcharges or allowing for greater tax deductions. These benefits may not be obvious, but can still be impactful. The fourth thing we love about Roth conversions is they help decrease the impact of the widow penalty. The widow's penalty is becoming more and more costly as women live longer and their wealth grows larger. Since many couples file as married filing jointly, an advantage status for every tax bracket except the highest one. However, once a spouse dies, then the surviving spouse is filing as single, which uses tax rates at roughly half of the taxable income of the married filing joint tax bracket. Their standard deduction is cut in half, along with the key income thresholds, thereby pushing the surviving partner into a higher tax bracket. This shift in tax rates can amount to about an extra 10% a year in a tax rate increase for the surviving spouse, plus additional Medicare premiums. However, the surviving spouse will typically have about 90% of the income, as the IRAs will go to them, and they can step into the higher Social Security benefits, which are often the deceased spouses, thus giving up their lower amount, which is typically not too significant. For example, we had a married couple in their early 70s, which is pre-RMD age, who had a total tax-deferred balance of about $2 million and was in the 10% tax bracket. We showed them that they were able to do a $115,000 Roth conversion and stay in the 22% tax bracket. But the point that pushed them to do the Roth conversion was that our projections showed when the first spouse passed, the survivor would likely be in the 32% tax bracket or higher, and that assumes our current tax rates stay the same. This is a main reason why most people will pay tax rates that are higher in retirement than immediately before retirement, is there will be a sole survivor and they will be filing single. One more pro tip for you. Make sure to consider tax rates if your spouse passes. If the rate in retirement is higher, you want to engage in tax planning now. With this, most husbands do not want their wives to have a significant tax bill when they are gone and are typically inclined to take action now. You always want to compare your current tax rate to 3 potential future tax rates in retirement. Once RMDs start, the filing single rate, and the tax rate of the heirs if they are inheriting a large IRA. The fifth reason Roth conversions can help is they can help drive down taxes during your lifetime and also position assets for the next generation. Roth conversions can help diversify your accounts from a tax perspective, which can then help to drive down your lifetime tax bill. In addition, building the Roth assets now can act as an estate planning tool, as Roth IRAs that have been passed to an heir have already had the income tax prepaid. Because an inherited Roth IRA doesn't trigger RMDs, your heirs can wait the full 10 years, letting the money grow and withdraw a lump sum at the end of the 10th year tax-free. However, tax-free distribution of earnings are subject to certain Roth limitations, such as a 5-year holding period from the time of the original account opening. When comparing today's rates with the beneficiary's tax rate, you may find that your heir's future tax rate is higher. If so, doing a Roth conversion today would essentially pre-fund their inheritance by paying taxes up front and also driving down the value of the estate. Last pro tip for you, the goal here is tax diversification to drive down taxes, which can be achieved by having the following 3 accounts. Taxable accounts that get taxed at a capital gains rate, which is generally lower than your ordinary income tax rate. Tax-deferred accounts, for example, IRA, 401k, or 457b, and tax-free accounts, which are Roth IRAs, 529s, and health savings accounts, with the emphasis on the latter types of tax-free accounts. The tax-free accounts also act as a great estate planning tool to allow your heirs to keep more money in their pockets instead of the government's pockets. In conclusion, Roth conversions can help reduce your overall tax burden, ultimately saving you thousands of dollars or even millions. Focusing on tax-saving strategies such as this will help to optimize lifetime taxes and maximize lifetime wealth for you and your heirs.